Well, thank you very much, and I'm very flattered at how many of you are here, at least partly to hear what I have to say. I must say, and Marek and Petra Roberts, who helped organize to invite me here, will know this. I was rather reluctant to come to this dinner, and it was quite hard to arrange a date that would suit me, and that was partly because of the name of the dinner, this forecasting dinner. Now, as I think a number of the earlier speakers said, economic forecasting has a pretty bad reputation. And so when I was invited to come to something called a forecasting dinner, the first thought that came to my mind was a comment that Galbraith once made about economic forecasters. He said there are two types of economic forecasters: the ones that don't know what's going to happen, and the ones who don't know that they don't know what's going to happen. I think that is true. It is in the nature of trying to deal with systems that are inherently too complex to be captured by any kind of simple models and so on. But I'm not sure that this is entirely a hopeless task. Another of the sort of cliches that is often used at the beginning of speeches like this about economic forecasters is that the question is, why were economic forecasters created by God? It was to make weather forecasters feel good about the job that they were doing. Now, that was invented as a sort of sarcastic remark about weather forecasters. But if you think about it, weather forecasts over the last 20, 30 years have spectacularly improved in their accuracy. And we are now at the point where actually weather forecasts are not a reliable source of sarcastic jokes of the kind that I gave, although I was glad that I got a few laughs at least. And I think there's an interesting analogy between weather forecasting and economic forecasting, which I just will talk about. This was not planned as part of my speech, and then I'll move into what I was really going to say, but it's related. If you think about weather forecasting, there are certain kind of forecasts that are actually now quite accurate. A forecast of what the weather is going to be like tomorrow or even the day after tomorrow is usually pretty good. A forecast that is almost invariably good is a seasonal forecast. I can tell you with 100% confidence that the average temperature in June is going to be higher than the average temperature in January. And I'm very unlikely to be wrong. In the very long term, there's also some, although not still very controversial, ability to try to understand what might happen to climate systems in the long-term future. Now, of course, this is questionable, whether we really do know anything about climate change and global warming and so on and so forth, but there is more and more of a consensus that we can get some ideas about the very long-term evolution of our climate. So, very short-term forecasting, seasonal or cyclical forecasting, and very long-term structural forecasting have some value in weather, and I would say they also have some value in economics, which is what I'm going to come to. Unfortunately, what doesn't work in weather and what doesn't work in economics are the kind of forecasts that people really want to know, which is, will the temperature next August be above or below, or how far above or below the average temperature for August over the last 10 years? Or will 2015 be a warmer year than 2013? And that, of course, is exactly what's needed by the business community, which is why economic forecasters have this very bad reputation. But the fact is, as I said, if we look at cycles, there is some validity in what we do, and I think there is at least some plausibility, some possibility of coming up with useful ideas about the very long-term structure of the world economy, just as there is about the climate system. Now, what has that got to do with our business and the rest of my speech? Well, that's related to the title of this talk, which I chose, Beginning of the End or the End of the Beginning. It's based on this comment by Churchill, which he made in a famous speech in November 1942, after the British Army finally managed to score a victory over Germany in the Battle of Alamein in Cairo. And he said, it's not the end of our war, it's certainly not. It's not even the beginning of the end, but it may be the end of the beginning. A shift in the trend away from downwards to upwards. And I think that's an interesting concept with which to think about what's going on in the world. Because clearly, the last 4 years, contrary to a lot of people's expectations, have been a period of improvement in the world economy. It's been a cyclical improvement. In a way, this is very close to what I was saying about the temperature in June is higher than the temperature in January. It was actually very easy, at least with hindsight. It didn't feel so easy at the time, but it was very easy with hindsight to say in March or April 2009, this is so much an economic winter, the temperature is so cold that it is almost guaranteed that over the next few years, the temperature is going to get warmer. There is a cycle, there's always going to be a cycle, however bad the world economy is, however serious the financial crisis, at some point things will hit bottom and there'll be a cyclical revival. So one possibility is that over the last 4 years, we have simply seen a seasonal cyclical revival in the world economy, and after 4 years of that cycle, it may well be the beginning of the end. It may well be, as perhaps suggested to some extent in Dr. Singer's charts, that yes, there'll be another decent year, and then it's time for a cyclical slowdown. Another possibility, though, which I'm also going to discuss, is that what we've seen over the last 4 years is just the beginning of a structural upswing that is going to last for a lot longer than a normal cycle of 4, 5, 6 years, the beginning of perhaps a decade-long or multi-decade structural upswing that follows the long structural downswing, which we can now see looking back, which wasn't obvious in 2007 and 2008, but when we look back at the period really starting from the late 90s, it's clear that there was a structural downswing lasting for quite a long time, arguably even way back into the 1980s. So is this the end of a cyclical upswing or the beginning of a structural improvement? Well, one way that we can see that question reflected, it's not answered, it's reflected, is by looking at the way financial markets have performed, and that's what most of our business is involved in. So if we look at the performance of the stock market over the last 10 or 15 years, in a chart like this, it really looks as if this may be the beginning of the end. It's been on a sort of gradual parallel rise, but in real terms, more or less flat or even slightly down. And there have been 3 upswings followed by 2 downswings. And it looks like the stock market, the S&P 500, which is the most important stock market indicator that really sets the climate for the whole of the world asset markets, it looks like we may be at another peak, which could be followed by another severe decline, like the one we saw in the early 2000s and again in 2008. So that's a possible structural, cyclical view of the world. But then there's always, in economics, another way of looking at the same data, which is this. Let's take a much longer view of exactly the same figures, the S&P 500, but this time going back 100 and some years to the beginning of the 20th century. And what we see there is that on this very long structural time span, there have been a number of periods, there have been 4 periods over the last 100 years of long-term bear markets where equity prices and other risk asset prices have been essentially flat, which means in real terms for most of that period, downwards for long periods ranging between 12 and 17 years, followed by upswings lasting typically from 15 to 20 years between those bear markets. And the interesting thing about that chart is, as you can probably make out just at the end, is that there has been a breakout, a very significant, not just a breakout by a few percent, but a breakout by a very significant amount, which really began at about this time last year. It was in March 2013 that the S&P 500 broke more than 5% above its previous highs, and that breakout has now gone to 15% and has been sustained for over a year. So that suggests to you that the first chart is in a sense the textbook of the people who believe that we've enjoyed a 4-year temporary cyclical upswing, which is now going to lead to a new recession, whether it's next year or 2015, and a new bear market, and therefore that all that's happening is a continuing, highly volatile cycle within a fairly poor state of the global economy. What this tells you is that there are some people in the investment community who believe that somehow beneath the surface there is perhaps a structural change going on in the world economy, which is going to move us out of a 13-year period of poor economic performance, bear market conditions in equities, into a period of potentially sustained growth, which would last 10, 15, 20 years, similar to the period from 1980 to 1999 or the 1950s and 1960s. So which is it going to be? Well, let me surprise you by saying I don't know the answer. But the answer, even to try to analyze the answer, which is I think all that we can do, we will only know the answer in hindsight, looking backwards, really depends on, in many cases, examining the same statistics, but examining them from different points of view. And this is, I think, what's going on at the moment. There are structural issues that you can see as being very negative, but there are also some structural issues that can be seen as rather positive, and each one of us will have a different opinion of where the balance between those issues lies. So I've just listed here 6 of the obvious structural obstacles to long-term economic performance, which most of us have heard a lot about over the last few years particularly, but which have actually been around in many cases for longer than just 2008, arguably since the beginning of this century. You can read them for yourselves. I don't need to go into them in detail. But these are the issues that, in a sense, were largely neglected in the upswing of the cycle between 2003 and 2007, and suddenly became obsessions of the financial community first, but increasingly of the business community after the collapse of 2008. So, bad public policy. Until 2007, everybody, including, of course, the policymakers like Dr. Singer, thought that monetary and fiscal policy was very good. And so, Dr. Greenspan was considered the hero of our times. Suddenly, in 2008, these same people who were just as competent and just as public-spirited as before, suddenly were identified as villains, idiots, incompetents, and so on. So suddenly, we had this obsession with bad public policy. And I'll come back to that because I disagree with this. Secondly, of course, there's now this concern about credit bubbles in China. We all know about that. I'll say a few words very briefly. Deleveraging. I think a fourth big structural problem, which perhaps hasn't had as much attention as it deserves, at least until recently, has been the effect of income distribution, the widening income distribution both within nations and globally on consumption patterns. And in a sense, I think we've moved towards almost sort of classical Marxist crises of underconsumption, where you have an income distribution such that it's very difficult for capitalist economies, it seems very difficult for capitalist economies to generate the demand for the goods that they're extremely capable of producing, because the incomes from creating those goods goes to people like many of us in this room who don't have the capacity or the need to consume that much. So that's another one. Obviously, we all know about environment and commodity constraints, which came into particular prominence in 2011, the idea that the rise of China was going to lead to explosive rises in commodity prices, shortages, and so on and so forth. And more recently, somebody asked the question about robotics, but strangely enough, the consensus, I think, among economists and many policymakers at the moment is that, in fact, productivity growth has gone down structurally rather than going up, despite the many technologies that we're all aware of. So these are big structural obstacles, and if you just focus on these, you would think that this picture of the world is completely absurd. There are these really bad things going on, and how could you possibly argue that we're just on the brink of a major breakout, not just in terms of stock market prices, but global economic activity and prosperity. On the other hand, you can look at the same world that we all live in from a different perspective. And this, in many ways, is the perspective that many of us, I suspect, in this room, and certainly I had, until October 2008. What people were preoccupied with and fascinated by between the late 90s and 2007, 2008 were these tremendously powerful, positive drivers of global growth, the tremendous tailwinds that basically all started in 1989 with the collapse of the Soviet Union. So you had the end of communism, the creation for the first time in history of a genuine single market that embraced the entire world economy. You had 3 billion new producers, increasingly consumers, coming from China and other emerging economies. You had the incredible breakthroughs in information and computer technology. We all got very excited about that, certainly in the late 1990s. And these breakthroughs have not suddenly stopped, they've continued. You had, again, this is a structural factor that I think is very important, but I think hasn't received as much attention as the first three. Really the invention for the first time in 5,000 years of recorded history of pure fiat money, which really was a process that started with the breakdown of the Bretton Woods system in 1971, of money all over the world that was not linked to gold, silver, slave, salt, or any other objective standard, and was purely dependent on the integrity and confidence of governments, nation states, and public servants, such as Dr. Singer here, had a sort of mixed effect. On the one hand, and this was the story of the 70s and 80s, people thought this is terrible, this is going to lead to inflation, this is unsustainable. But by the mid-1990s, the world learned to live with pure fiat money, and suddenly an enormous constraint that had been imposed on global economic activity literally for 5,000 years of history, the gold standard, the silver standard, the dollar gold exchange standard between 1945 and 1971 disappeared. And national economies were able to run, if they were lucky and if they were well managed, on the basis of their own productive constraints rather than external constraints created by a system of artificial money. So this was again a huge structural breakthrough. And then we've got a few others that I think have come into focus in the last few years. The alternative energy revolution. Whether you think that it's going to be more economic or less economic, whether you're worried about climate change or not, the fact is that the energy infrastructure of the world over the next 20 or 30 years is being redefined in many different ways. And the level of investment that is going to require, physical and financial investment that's going to require, is certainly on a scale of any of the industrial revolutions of the past, the railway revolutions, et cetera, et cetera. So a tremendous amount of new activity coming from alternative energy. And then finally, of course, going, the other side of the question about weak productivity and underinvestment, we have Moore's law, the continuing acceleration of information technology, which is leading to all kinds of applications which nobody even dreamt of 5, 6, or 7 years ago, whether it's robotics or driverless cars or any number of innovations in service industries as well as manufacturing. So these things are also going on. And the question is, which are going to be more powerful? Are they these 6 growth drivers or these 6 obstacles? And I'm sure there are others that we could all name. And there's no way of answering that question in advance. All we can do is observe what is happening in the world, but I think the way we observe it depends, and the information we extract from our global observation depends very much on our point of view, as illustrated by this famous picture from behavioral psychology. Whether you expect to see a duck, a bear market, or a rabbit, a leaping bull market, will largely determine what you actually see in the data. And that's why it's not just very difficult, but impossible to come up with a really objective analysis of where the balance of these structural forces lie. But what I would like to persuade you about is that at the very least, you should keep your minds open to the alternative point of view, whichever of these structurally you are. If you're a structural bull, see leaping rabbits, bear in mind that there is often another way of seeing the world, which is a duck, a zero, a falling market, and the other way around. So that's the big picture, if you like, about the structure of the world economy. But I said at the very beginning that there are a few things that economists can do more reliably than speculate about what's going to happen in the next 10, 20, 30 years, whether it's with technology or energy or so on and so forth. And that is analyzing the cycle. There is a certain consistency, and there's a very clear logic to the cyclicality of the world economy. And so for the next few minutes, I'd like to tell you what I believe about the cycle, and on this I have quite strong conviction, and then at the end I'll just say a few more words about these structural issues, which are much more speculative. I think that when you look at the cycle, despite the first chart that I showed you of the stock market sort of bouncing against a potential long-term high, I think if you look at the cycle not through financial perspective, not a financial perspective which is obsessed by the fact that stock market prices have gone up by 160% over the last 4 years or whatever it is, but if you look at it from a macroeconomic perspective, which is what I think central bankers quite rightly tend to do, I think then you come to a pretty robust conclusion that the cycle is not over, it's far from over, and in fact it's still in an accelerating upswing phase rather than a slowdown and downswing. And the evidence for this, I think, comes first and foremost from the US, which always has tended to lead the cycle in the global economy, and I think is doing so even more than before this time round. You see the US economy accelerating, behind that, two other fairly significant economies, the UK and Japan clearly picking up, Europe at least stabilizing, and strangely enough, the main uncertainty about the global cycle in the next couple of years comes from the part of the world that most of us, including me, felt most confident about as recently as 6 or 9 months ago, which was the emerging markets.